Hey there, and welcome inside of Three Peaks Trading. In this video, we're going to teach you one of the core strategies when it comes to position trading. Now, this is not about day trading. This is not about swing trading. This is about position trading, or what some people would refer to as investing. We've actually created a strategy that has a phenomenal win rate, as much as 90%. And I know if you've been trading for a while, or if you've seen a lot of literature on trading, you may think there's no way that anybody is winning 90% of their trades. But I can assure you that is not the case. It is possible to win 90% of the time when you apply appropriate techniques and proper risk management. And we're going to teach all that to you inside of this single video. The video itself, it may be a bit long, but I want to walk through this from A to Z without leaving any pieces out. So before I jump into the actual strategy itself, I want to say, number one, like all trading strategies, there is risk involved. There's an actual risk that you may lose 100% of the money you invest. For that reason, you should never invest more money than you can afford to lose. And not in a ha-ha cliche disclaimer sort of way. I'm saying to you in a genuine manner, do not invest money you cannot afford to lose. I have seen students over the last 4 years go through some really rough periods before joining our courses. For example, we had a student in late 2017 who got caught in the bubble. As a result, he ended up losing nearly all of his life savings, and his wife left him. Those are the stories we want to avoid, but I want to show you how you can use this strategy with proper risk management, so if something does go catastrophically wrong, you are still able to survive and life goes on. Now, with that being said, what is the risk with this strategy? What would cause you to lose your entire investment? And really the answer comes down to this. The assets that you invested in would have to go to zero or near zero for that to be the case. In almost all cases, if you employ this strategy correctly, as long as the asset doesn't completely die, you stand a very good chance of making a profit on the trade. Now, one of the things that sets this strategy apart from most strategies out there is it does not require any technical analysis. Most strategies are going to expect you to understand how to read a chart. They're going to expect you to understand chart patterns. They're going to expect you to understand things like Fibonacci levels. And all of those are amazing tools, and we use them in our day-to-day trading. We use them in our swing trading. But when it comes to this particular strategy, they are simply not necessary. So I'm going to have a chart pulled up in this video simply so that I can show you some levels, but the chart has nothing to do with when we enter a trade. So essentially, the strategy that we're going to be teaching you inside of this video is based on something called martingale. If you Google martingale strategy, what you're going to find out is it's an old strategy. You can see here, martingale is any of a class of betting strategies that originated from and were popular in the 18th century France. The simplest of these strategies was designed for a game in which the gambler wins the stake, the coin comes up heads, it loses, it comes up tails. The strategy had the gambler double the bet after every loss so that a single win would recover all of the losses. That's really all you need to know about the original martingale. What we've done with this strategy is we have basically tweaked it for modern day trading. And more importantly, we've applied a very specific strategy that breaks our martingale bids into sections of 5, and sections of 5 that are weighted heavily toward the bottom. So let me show you exactly what I'm talking about. I'm going to use Ethereum as an example. We're going to go through a few different charts. I'm going to show you how this works. So Ethereum is currently sitting at nearly $3,400. We don't care about that. What I want to do is I want to go back in time to 2017. And I want to pretend that you were a new trader at this time and that you, by mistake, got caught up in the FOMO on Ethereum. So Ethereum had just peaked at over $1,400 in January of 2018, and then it had this huge dip. Now, in this hypothetical situation, we're going to pretend that you were at least smart enough not to buy the actual top, but to wait for a dip to buy. Well, if you simply bought this dip down here, obviously things went pretty bad for you because price continued to fall and fall and fall. And eventually, if you held long enough, you did get out for even, or you might even be in a profit. And that's one way that people will invest. They'll simply buy an asset and hope and pray that someday it goes back up. Sometimes it works out, other times it doesn't. For example, let's say you employ the exact same strategy on Verge. Verge ran all the way up to 30 cents, a little over 30 cents, and today it sits at around 5 cents. So you would still be down more than 50% on Verge. But when we go back over to Ethereum, let's say that this person instead was strategically buying Ethereum on these drops. So for example, the all-time high was $1,419.96. So $1,419.16. If this person bought their first Ethereum after it fell 50%, they could have put in $100 and bought roughly 0.14 Ethereum. Now this says shares because I'm also going to talk about stocks in just a few minutes, but obviously we know we're talking about crypto right now. So 0.14 Ethereum. And you might think to yourself, well, that's not very much Ethereum. No, it's not. But the idea is we actually don't want it to go back up at this point. If it does, fine, we can take it, we can ride it, we can sell it for a profit. If it bounces, whatever. But we're actually rooting for Ethereum to continue dropping when we're using this strategy, because if it were to drop another 50%, we would double down and put in 200, not 200 total, but a fresh $200. And at that point, we would be able to buy 0.56 Ethereum. So that was at $354.79. So what I'm going to do, I'm going to go to the chart. I'm going to actually mark these levels up so you can see them. The first one's at $709.58. $709.58. That's where we would have bought our first Ethereum. Our second Ethereum would have been purchased at $354.79. So $354.79. $354.79. And you can see that Ethereum actually dropped down here to $360, so it didn't quite hit our fill. So this is a perfect example of what I'm talking about. When this bounced, we could have, maybe, if we decided to, we could have sold this original position. This would have been our only Ethereum, 0.14 Ethereum, and it actually bounced about 16%. So we could exit the trade at that point if we decided to, take our 16% profit and wait for another opportunity. Or if we're long-term investors, we could say, you know what, we're not going to sell just yet. Let's see where this thing goes. It's either going to go higher and going to make even more money, or it's going to go lower and I'm going to get a chance to buy more Ethereum. So in this case, it dropped more, and right here, our second bid would have been filled. Now, after these two bids, if we do the math, we're going to have a total at this point of 0.7 Ethereum. Just adding these two together, that's how much we purchased so far. And we would have spent a total of $300, adding 100 to 200. Meaning that our cost average would have been roughly $425.75 per Ethereum. So our cost average would be sitting right around this $400 mark. As Ethereum continued to drop, we would set our next target at $177.40, which means we would have got a fill right here in September of 2018. Now that fill would have been for $400 worth of Ethereum, meaning we would have bought 2.25 Ethereum, bringing our total up to 2.96 Ethereum and our total investment up to roughly $700. That means our cost average would have been $236.53. So our next buy would have been at $88.70. So let's put another buy on there. And you can see that would have got a fill in December 2018, would have been literally just a few dollars from the actual bottom on Ethereum. So by the time we got those 4 fills on Ethereum, it never did drop to 44, so this 5th one would not have filled. We would have purchased a total of 11.98 Ethereum, and we would have had a total investment of $1,500, meaning our cost average would have been $125.22. which is really amazing when you consider that we started buying Ethereum at $709, but we ended up with a cost average of $125, which was just a few dollars from the actual bottom, right? Or about 20 to 30% from the actual bottom down here. So when this pumped up in the summer of 2019, had we decided to sell, we could have sold this Ethereum for as much as $364.49 per Ethereum. So in this case, we didn't get the fifth fill, so I'll delete that. We've got 1,500 invested, 11.98 Ethereum, 125.22 cost average, and we just said that we could have sold for a high of $364.49, meaning that we would have turned a profit of $2,866.20 on a $1,500 investment. That's nearly triple. But look what would have happened if we were long-term investors. If we were looking at this saying we're buying on the way down, we want to hold it for the next bull market. If we were still holding that Ethereum, Ethereum is now worth $3,378. Meaning that $1,500 investment would currently be up $38,964, which, for those of you who are fans of math, would be a return of roughly 2,598%. A pretty phenomenal return by anyone's standard. Now, you might be wondering, James, how do I figure out how much to buy at each level? And that's what I'm going to explain to you right now. Trading is all about risk management. That's the key to trading. That's the key to being successful at trading. We never want to put ourselves in a position where if a trade goes bad, we can't come back from it. So the general rule of trading is you'll never invest more than 1 to 5% of your entire portfolio into one single asset. So let's say, for example, that you were trading with a $10,000 budget. Let's say that's your entire budget for investing. It's a fairly low budget, and I think it's a fairly reasonable budget for most people. So if you're going to go on the high side, you can invest as much as 5% of that budget, which in this case would be right at $500. So what you want to do is you want to make your first buy 3.25% of that budget. Now, this is all part of the strategy, and I'm going to show you why, okay? Because what happens when all these are figured in, if all 5 buys fill, that will give you a total investment of roughly $503.75. That's what we want to do, is we want to get right at that number that we're looking for. So, for example, if we only wanted to risk $300, then what we would do is we would invest 3.25% of $300. And you can see here 10, 20, 39, 78, 156, because each level doubles. Would have been a total investment of $302, and this trader would currently be up about $15,525, meaning that they would have more than doubled their entire trade fund on this one play that went really well. Had it went really bad and Ethereum went to zero, the most they could have lost was $302.25. So Ethereum is one of these rainbow picks. It's really high right now. It's had a really good run over last year. But what I want to do now is I want to take a look at a coin that didn't do so well over the last year. So let's switch from Ethereum to Verge, which was the example I was using earlier, because it's nowhere near its old levels. So we're going to go to Verge USD, which we can look at over on Bittrex. And let's say that we did the same thing on Verge. We looked at it, we got super excited about it. It had went all the way from less than a penny to over 31 cents. In fact, Verge went up so much in 2017 that a $100 investment in January 2017 was worth over $1 million in December of 2017. So there was reason to be excited. So let's take a look at this. The high was 31.197. I'm going to round that up to 31.2 cents. 0.312 cents. Which means that our first buy would have been roughly 16 cents, right? 15.6 to be more precise. Our second buy would have been 7.8 cents. Our third buy would have been 3.9 cents. Our fourth buy would have been 2 cents. And our fifth buy would have been 1 penny. So what I'm going to do now is I'm going to go over to the chart. I'm going to start marking these levels up. 15.6 cents was level number 1. Level number 2 was 7.8 cents. So again, we can see how this would have worked out after just 2 buys. Here's our first buy. Here's our second buy. Our cost average on those 2 buys. We would have had roughly $29 invested. We would have had roughly 313 Verge, meaning that we would have paid roughly 9 cents per Verge. So when Verge had this run in April 2018, it pumped all the way to nearly 12 cents. We could have sold for about a 30% profit. But let's say that we were, still suffering from FOMO. We thought it was going to go all the way up to 50 cents or $1 or whatever. We could have continued to hold. We would have next bought Verge at 3.9 cents. We would have next bought Verge after that at 2 cents. So we'll put a line on there, 0.02. And finally, we would have bought our last purchase of Verge at 1 cent. We would not have continued to buy after the 5th month. We would have simply stopped and waited to see what would happen. So when this was all said and done, by, looks like, August of 2018, we would have been done buying Verge, and we would have been sitting on our hands waiting for Verge to do something. By that point, we would have had $302.25 invested if we were using 3% of a $10,000 budget. We would have owned 21,312.5 Verge, and our cost average would have been roughly 1.42 cents. Now, Verge pumped all the way up to 7.88 cents just last month. Meaning that if we had sold our Verge last month, we would have made a profit of roughly $1,377, which again would have been a return of roughly 455%. If for some reason we didn't sell Verge and we are still holding it, it is currently worth 5.26 cents. So 0.0526, meaning that we would still be up about $818 on a $302 investment, which is a return of 270.9%. And again, I'm using Verge because Verge didn't do so well. Now, I'm going to do one more example. We'll run through it very, very quickly, and this is actually an example on stocks. So there was a company called iBio. It was one of those, biomedical companies trying to produce medicines, whatever it is they do. We don't really care, right? We don't care about TA. We don't really care about fundamentals that much, other than obviously we want to try to avoid investing in companies that have a high likelihood of going to zero. So back in 2011, this company was very, very hot. It ran up to $60.60. It's currently sitting at $1.32. So you might be thinking, well, there's no way that this strategy would have made me a profit on a stock that's currently down over 90%. But you would, in fact, be wrong. $60.60 was the high. So again, using the same numbers, a $10,000 budget, using 3% risk, we would start out by putting a $10 investment. Now, side note, with stocks, it's a little bit different because you typically are not purchasing fractional shares. You're typically going to be purchasing whole numbers. So not 0.32, you might purchase 1 share, 2 shares, 4 shares, so on and so forth. But we'll use this example so that we can stick with the math. So they would have been making their first buy at $30.30, their second buy at $15.15, $7.57, third buy at $3.78, and the fourth buy at $1.89. Meaning that they would have had a total of $302.25 invested. They would have owned just shy of 110 shares, and their cost average would have been $2.75 per share. Now, I'm not going to mark the chart all up because I think you understand how that works, but I do want to show you this. If our average was $2.75 per share, we'll round it up to $2.76. Watch this. So the last buy was at $1.89. So when did it fall under $1.89? Not over here, so we wouldn't have got this pump. But we would have got this pump. This pump went all the way up to $7.45. So this trader would have had an opportunity to get out of this trade for a profit of 170%. And here's the amazing thing. They would have actually had a chance to get out even better than that. Because after they had made these first 4 buys, they would have been into this stock for roughly $146. They would have owned roughly 27.35 shares, meaning their cost average would have been $5. In fact, $5.35. Meaning that way back here, they would have had a cost average of $5.35 just before the stock pumped to $35, which would have been over 600% return. Are you starting to see the power of this strategy? We could go look at nearly any chart and we're going to find out as long as the stock or the coin does not go to zero, this strategy is going to be very, very effective. Now, I want to show you something else because I want you to believe that it is possible for something to go to zero. So I'm going to share with you one of the stocks that I try to do this with that blew up in my face. There was a stock called MoviePass. It was actually called Helios and Matheson. And you may or may not have heard of MoviePass. It doesn't really matter. Essentially, they had a service where you could pay a one-time monthly fee and see as many movies as you wanted at the movie theater. I really liked the service. I actually bought the service for my family. We really enjoyed it. I believed in the stock. And so when the stock started to have major, major issues and fall, I started buying that stock. Now, this stock underwent something called a reverse split. So it looks like on the chart, this stock was actually $11,000 back here, but it really wasn't. They went under a 250 reverse split. So this was actually, $11,718 divided by 250. If you're not familiar with stocks, that might be a little bit confusing, but it's just kind of a weird deal that happens. So really its all-time high was around 47 bucks. I didn't start buying this stock until it was 85 cents. So I felt pretty good that I was going to make a bundle of money on this, that my risk was very limited. So when it was around 85 cents, I put money in. When it fell to 40-something cents, I put money in. When it fell to 20-something cents, I put money in. When it fell to 10 cents, I put money in. When it fell to 5 cents, I put money in. And I'm sitting on thousands of shares of this stock thinking when this thing goes back up to $30 or $40, I'm going to literally make 6 figures off of this tiny little investment. But what actually happened was very different. The stock ended up completely collapsing. The company had all kinds of problems. And you can see here the stock actually fell under a penny. And then it was completely delisted from the exchanges. So right now it's trading over the counter. And it's currently worth about 1/2 of 1 cent. Meaning that at no point in time was I ever able to sell my stock for a profit or even break even. I lost 99.99% of my investment on that stock. So I share that with you to make it very clear that yes, you can lose even with this strategy. It is just extremely rare because it really means that you picked a stock or you picked a coin that literally went to zero or near zero. Essentially, what happens when you use this strategy, you can suffer drawdowns of over 90% and still come out profitable. Let me show you an example of this. Let's look at this stock that we just talked about. It had a high of $60.60. When it was all said and done, our cost average was actually $2.7545, meaning that our cost average was actually about 4.5% of the all-time high. Or, put another way, we actually bought this stock at a cost average of about 95% off of its all-time high. So as long as the stock comes back from a 95% drop, it doesn't have to come back a lot. It just has to come back some from that 95% drop. And that gives us the opportunity to get out for even. And this isn't just this stock. It's the same math no matter what stock you're looking at. For example, if the stock was an all-time high of 100 bucks, our cost average would have been 454, right? So again, we basically bought for about 95% discount. So as long as that stock doesn't die, as long as that stock bounces at some point, we should be able to sell our shares or our coins for a profit. Now, this works with stocks. This works with crypto versus US dollars, and it also works with crypto versus Bitcoin. Most altcoins in 2021 are still down in a huge way versus Bitcoin. So for example, we're not going to walk through this whole thing. We're going to go very, very quickly, but let's take a look at a coin that I personally invested in very heavily called OMG. It had a high of 0.00335 Bitcoin. It was 0.00335 Bitcoin. So in this case, what I'm going to do is I'm going to change some things around, and we're going to say this hypothetical trader had 1 Bitcoin total to trade with. So again, if we're using 3% risk, then they would be able to risk as much as 0.03 Bitcoin on this particular coin. So we'll take that times 0.0325, and that gives us our levels. And we can see this person would have been buying OMG at 0.0016, 0.0008, 0.0004, 0.0002, and 0.0001, etc., etc. Cost average would have been 0.00015227. And in the summer of 2020, that coin actually ran up to 0.00083. 0.00083. Meaning that this person who put in 0.03 Bitcoin using this strategy would have been able to sell that OMG at that summer pump for a return of 445.07%, meaning they would have made roughly 0.13 Bitcoin, which at the current price of Bitcoin would be about $6,000 to $7,000 profit on this very small trade of 0.03 Bitcoin, which back then would have been more like $300 risk, okay? And let's say they didn't sell for some reason. Let's say they were stubborn and still holding it. Currently, OMG is worth 0.00016160. So 0.00016160. So they'd be up about 6% if they were still holding it. The idea is not to continue holding the thing forever. The idea is when you see a pump where you have an opportunity to get out for a few $100, you take that and you run for the hills with your profits. And then you just rinse and repeat this formula over and over again. So again, I know this video is fairly long. This is only one piece of a much larger puzzle. And when I say one piece, this is one strategy. It's the complete strategy. It's how to handle the risk. It's how to pick the investments. You can see that it's not based on technical analysis. You can see that it's not based on fancy trading. It's a very, very simple mathematical formula that has a very, very high win rate. What we do is we take that and we actually add a little bit of technical analysis to it, which gives us even better entry points. So for example, on OMG, instead of buying way back here, we might have started buying way over here after it started showing signs of accumulation. Or for example, on a coin like Ethereum, we can look at Ethereum versus Bitcoin. We might have started buying over here where it started showing signs of accumulation. Now, sometimes you get that right. You get the bottom and it goes up from there and you're wonderful. Other times you're wrong and it continues going down, and that's perfectly fine because we just buy more and more and more. So a real quick example of this would be on Bitcoin. And I've got this chart pretty heavily mocked up with TA, but let's erase it all. Let's say that you were a big fan of Bitcoin back here and you started buying Bitcoin at this level down here because you knew a little bit of technical analysis and you knew that this looked like a support level. Well, then you would have been buying Bitcoin at around $6,500, which is great, right? Say 6,500. And if you were employing this grid strategy, this martingale strategy, when it fell over here to 3,200, you would have simply been happy, not sad, happy because you could have bought twice as much Bitcoin. So if you bought 1 Bitcoin here, you might have bought 2 Bitcoin down here. Would have brought your cost average to around $4,000. And then you could have rode that Bitcoin up, right? So very, very simple strategy. Anybody can execute this strategy. It takes a lot of the emotions out. It does take a lot of the technical analysis out, but it's only the tip of the iceberg when it comes to what we teach and how we make full-time incomes trade it. So if you like this strategy, be sure to keep an eye out for our future emails where we share even more strategies and even more content that will help you become a better trader. On behalf of myself and the other partners at 3 Peaks Trading, thanks for checking out this video and welcome to the family.